Welcome to the Weekly Spark, your fast 5-minute flash of insight into the world of mortgage and real estate. Every week, we're here to ignite your understanding of the market, from mortgage rates and housing trends to legislative updates and insider strategies. So let's strike the match and spark your week. This is the Weekly Spark.
Welcome back to another episode of the Weekly Spark. I'm Ryan, and I got Jason, of course, the co-owners of Creative First Mortgage. We are going to bring some awesome, relevant topics to you this week. Make sure you stay to the end for that loan spotlight. We're going to highlight a program that you will be able to use in your marketing after you watch this video. So let's jump right in, Jason. Let's add that. Go there. All right. So first up, we've got Trigger Leads. It says no more spam calls. What are we talking about?
Yeah, so I did a quick video on this before, but it's relevant now because it's actually passed the House and the Senate. So listen, if you've ever applied for a mortgage and then you got flooded with spam calls from random lenders, there's a reason for that. It's called Trigger Leads, and Congress just passed the Trigger Lead bill. And basically, here's what it means. So credit bureaus will no longer be allowed to sell your information to other lenders unless you opt in or you already have a relationship with that lender. So listen, no more surprise calls, no more mystery texts. This bill passed the House and Senate. It's heading to the president's desk for signature. And once it's signed, it'll take effect in about 6 months. Big win for home buyers as well as our refinance clients.
Yeah, that's a huge one. I know every time we get a lead in or get a new refinance application in, or somebody that already has a mortgage even applying for a new house, man, I think a couple of borrowers totaled up to about 120 calls in a 24-hour period, which is crazy. And so we do have some strategies that help block those calls right now. We do send borrowers to optoutprescreen.com. So if you're listening, make sure you're working with that as well and entering your information in there. That'll help cut down on some of those calls now, but I'm super excited about this to take effect. So next topic, we've got disagreement at the Fed. Are rate cuts finally coming? What do we got?
Yeah, so listen, we got 2 new Fed members that have now stated they are in favor of a rate cut. So this makes 4 Fed members pushing back on Fed Chair, our favorite person, Jerome Powell, to go ahead and cut rates. So the reason for this, I mean, listen, guys, there's clear signs of a slowdown in the market. It's a stagnant economy right now. And even with all the new tariff deals and investments into the US from other countries, we won't really see the impact of those tariffs for a while. So rate cuts could help boost this economic slowdown. So here's my prediction, Ryan. The Feds will cut rates in September.
Ooh, bold statements. I love when we make bold statements. That's great. No, I hope that's coming as well. I did warn a borrower yesterday that we were looking at locking in on a refinance. Initially when the rate cuts come in, we might not see the impact on mortgage rates we think we're going to see. It might actually spike them up for a minute just because of the way that they think that inflation is going to come in. And then, maybe a month after that or so, you're going to see that kind of trickle down effect and then mortgage rates will come back down. That being said, we will do a little deep dive into the rates here because I think you're in for a little surprise after what we talked about last week. We've had some good growth and good movement in the rates. So I'm going to go ahead and pop up the charts for you to go through here and we'll get you off on that. So what do we got on the rate outlook?
All right. So first off, let's go ahead and expand that screen. So listen, guys, we saw an incredible increase in the bond market. And of course, if you're watching our content, you know that a strong bond market equals better rates. So Ryan, I hate to be the guy, but I absolutely called this. I told you that it would probably hit to that 1.76 and it did. And we're seeing that we're building on this Fibonacci level, right? So if we can hold above this 1.76, we've got a lot of room to get up to about 2.09. So we're looking for a continued momentum to the upside here. Really like what I see on this chart. However, if we go to the 10-year, a little bit concerning. We did see the same drop through. So we broke through these lines of resistance. We hit exactly on this Fibonacci. It's so incredible how they respect these lines. But if you see this kind of curling upward momentum here that we're seeing, I don't really love that. So we got to be really careful on, what we're about to see potentially here in the 10 years.
So we can tell, we're kind of at that point of deciding factors, but we've got a little bit of a window here to lock in some of those lower rates. And so we got to kind of play the game day to day and take advantage of the cookies as they're passed, as they say. Jason, I think that's a great opportunity for people to learn a little bit. Let's jump into our mortgage loan program that we talk about every week. This is our loan spotlight. So this week we've got the 1% down loans. Tell me what you know about these loans.
So realtors, what a great way to market to your clients. We have what's called a 1% down program. It's a purchase only program, and it's a broker only program. And this allows brokers or borrowers rather with at least a 620 score to be eligible. It's a conventional loan, so generally cheaper than the FHA loan. And it's a great way to get into a home with very little down. It also avoids having to go through state-sponsored programs or having to get a second approval with another underwriting team for a grant or a second loan that has to be paid back. So absolutely great for our clients that are looking to buy a home with a little bit down.
Yeah, I love it. And it operates off those conventional guidelines, as you said. And the way that it kind of works, borrower brings 1%, the lender gives 2% up to $7,000. So they can, that increases that purchasability there a little bit. And it's just a great program for those slightly lower income borrowers, because we do have to worry about those average income in the area. But it's a great program to get out there and market towards your borrowers and let them know, there is opportunities to get in with a little less money than what you're being told everywhere else. So awesome, man. I appreciate you again with the great information, and we'll see you next week.
See ya. That's a wrap for this week's edition of the Weekly Spark, brought to you by Creative First Mortgage. If you've got questions or want us to cover something next week, please let us know, shoot us a message, and until then, keep your deals moving and keep your week lit. See you next time.